You see 34.50 as your target, but you say there's upside risk to that. There's upside risk at 39.50. That's a huge move from here.
We do. It's actually kind of surprising to us that here we are at new all-time highs. It's been an excellent year for equities. And the glass seems as half empty as ever in terms of people's attitudes. And, correct me if I'm wrong, is that in 25 years of doing this, you really don't see markets top when people are pessimistic or cautious. And we see caution. To us, the biggest story for 2020 could be this idea that after 10 years of grudging, or actually, if you look at the money flows, no participation, actually a movement away from stocks, that the public actually returns to the markets. It's very consistent with behavior that we see toward the late stages of bull markets. We do think that the public could get interested, and that's how you overshoot to as high as 39.50.
So where would the public get interested? I mean, it feels like it's been a rising tide lifting all boats. Are there ignored areas that might attract this so-called public that you talk about?
Well, it's not so much that there are areas that are ignored. Clearly the story of 2019 has been the last quarter's convergence of very, very depressed cyclicals, financials and energy, towards the more defensive, typically utilities and consumer staples, which had been a hiding place for the most part of the year. We think that the inflection in the bond market in September is very important and very good for psychology, and that's the kind of recipe for us that when people take a look at their portfolios and they realize how much exposure they have to bonds relative to stocks, given the fact that the inflows have been going toward bonds, is that they'll reconsider, and at 19 times, really 19 and a half times, both present and our estimate for 2020, stocks are not expensive. They really aren't.